All right, folks, I'm here with Sarab Singh, SBA lender at Huntington Bank. Sarab is based out of Illinois. We've done deals together before. We've flipped golf carts, or Sarab technically actually
Oh,
flipped.
you want to start with that? Okay.
Yeah, maybe the question is who is in the driver's seat, who's in the passenger seat, right? I think you were driving at this point in time.
That's true.
Bags
True.
flew over, sand started flying everywhere.
Yeah, but you're only as good as your weakest link, so
Right,
it takes
right.
two to tango. But we survived.
Yeah, we're here today. So, Sarab, give a quick background on yourself and Kev, how do you get into SBA lending? I know lots of interesting characters are in this space. You have folks wearing cowboy hats. You have people that look like they haven't got off their desk in 10 years. How did you get into this space?
No, thanks for having me on. I appreciate it. Sarab Singh, like Matthias said, here in Greater Chicago market. I've been here for on and off about 15 years. My wife and I live in the north suburbs of Chicagoland. We have two kids, daughter's 10, son's 8, so they keep us pretty busy. But when I'm not with the kids, from a banking career perspective, I've been in banking for a little under 20 years. Started my career with JP Morgan Chase in New York City. So I've kind of a gamut of different things. I've been with the big banks down to the regional banks.
Have you ever met Jamie Dimon or no?
I don't think, no, I've never met Jamie, but I've met some of the executives at some of those top performers or some of those events. But
Is
uh,
is New York, so not to digress from your background, is New York banking actually like what it, how like on Netflix, Amazon Prime, do you have helicopters that are picking up these bankers, flying them to the Hamptons? Is it that?
they did not pick me up
No.
to go to the Hamptons. But I will say that there's a saying that if you can make it in New York, you can make it anywhere. And it holds true because there's so much competition. And, there's every corner with a Starbucks on every corner. It's a highly banked market.
Yeah.
So I do, if you have some success in the East Coast, you can replicate that into other parts of the country. But yeah, so JP Morgan, I also worked at another big bank, Wells Fargo, as well, here in Chicagoland. And in between, did a stint with US Bank in Cincinnati, Ohio, and Chicago. And then obviously most recently here with Huntington Bank SBA. So along the way from personal banking, business banking, commercial banking, and ultimately ended up here SBA last year with Huntington Bank. And the reason I chose to come to Huntington Bank was because where else are you going to get this kind of activity with small
Interesting.
business? There's so much volume, so much good deeds to be had in Main Street.
Yeah.
And for me, I was pretty passionate about getting back to small business banking as I've done some of that in my past roles. So
If I heard correctly, you mentioned you worked in Ohio for a period of time.
I did. I was in Cincinnati, Ohio, with bank, where I was more focused on practice,
Wow.
healthcare lending.
I don't know if I've ever met a normal person that's like come from Ohio. My wife told me a story one time. Her and her family were driving. It was somewhere in the southeast, and they were stopping through Ohio. And they stopped into a grocery store, and like they were walking in the aisle, and people were just looking at them. And her dad just looked at the family. They were like, "We need to get the hell out of here now."
Yeah, when you go from the East Coast to the big cities and you come down to smaller markets, I remember when I first got into Cincinnati, the question was, where did you go to school? And I was like, well, I went to East Coast private school in New York City. They're like, no, but where'd you go to high school?
Yeah.
I was like, okay, you're in a
Interesting. So how do you like Midwestern life relative to New York?
It's I love it. I think I can ever go back home to New York City because I'm so used to having space.
Right.
And people are a little bit easier going, right? So it's a little bit more peaceful. It's not as hectic. And especially after having a family and kids, I feel like this in Chicagoland, the north suburbs, we like our space.
Yeah.
Yeah.
Yeah, here is the phrase fib. So when they talk about people from Illinois, and so the one great thing I like Illinois is, you have Chicago, major city there. The tollways are very efficient, but it's like getting into actual Chicago from I-90, it's like the moment you're approaching this, it's a pain in the ass getting it.
Yeah, it's funny. I'd rather go to Brewers or a Bucks game than go
Yeah.
downtown to United Center to catch
Yeah.
a Bulls game or go to Wrigley for a Cubs game.
Yeah.
Just so much easier to go north, especially for me. I'm probably about an hour from the Wisconsin border.
Interesting.
Yeah.
So talk to me about, we've closed some deals recently with the whole cast of characters, some more interesting than others. Talk to me from a
Yeah.
high level about current market drop, avatar or kept profile of buyer that you're seeing actually getting a deal done. So like is it people coming from Wall Street, the ivory towers of New York? Like, where are these people coming from?
Simple. I mean, just it's a big ecosystem of small, I think there's a data out there, 30 million small businesses under 2 million in revenue. So what that means is it's a huge opportunity for a lot of folks to come from different parts of the industry, such as private equity, strategics. You have corporate executives coming in because they're to figure out a way to diversify their income streams and get out of the 9 to 5. So I would say now it's not just your typical mom and pop couples or husband and wife or two partners kind of rodeo show. You have more
Yeah.
of a strategic focus in SBAs in small business.
And have you seen that? So like I know obviously we had back in 2023 the SBA changed to make things more flexible. The the partial buyout structure originated back at that point in administration.
Yep.
Then all of a sudden the full standby seller's note, which I proudly own the trademark to, became not to give a commercial show, became the 2-year standby note and being able to do that and then switch back. How have you seen so before 2023 to when the guidelines became more flexible to now? How have you seen the people that are reaching out to you on deals change
Mhm.
from a strength standpoint? Would you say that it got diluted back in 23 when the guidelines changed and now all of a sudden people are stronger? Or do you still see a lot of those weaker people in the pool of folks reaching out to you?
In my opinion, I think the buyer pool is getting stronger after the 50-10-8 SOP change that went into effect June 1st, especially with the 10% minimum injection requirements on change of ownership, business acquisition deals that we primarily focus on. You got to have some skin in the game in today's times. I think prior, and again, social media doesn't help, right? You have this 100% financing, no money down all over the web, folks kind of giving out that messaging,
Right.
which that's not the truth. That's not reality. So I think now the buyer pool's gotten a lot stronger where they have liquidity, they have decent personal financial statements, and they have the wherewithal versus prior where you probably had folks that maybe were lighter from a cash perspective. So
Yeah. What about some of these folks, Sarab? So like I'll have to reach out to me or my sales Raphael or Alan via email, and they'll have like a initial deck on, I want to roll up on the next 2 years. They've done business before, but they come from private equity or whatnot. Are you seeing those types of people? They're kind of more of the every once in a while, or not too many?
and there are, and again, if you're talking about folks, investment banking, private equities, that's kind of the lingo they're used to, right? Everything's a roll up, everything's about reoccurring revenue and growth over year of 100% plus. Trying to add-ons, add-ons and so forth. I would say we get those calls and we get some of the, I don't know if I can use that word, but
Yeah.
we get some folks that maybe don't have the right profile
Right.
strengths perspective, from a background, from experience, from a personal financial statement that have the cash to be able to take on some of these bigger opportunities. So I would say it's a gambit, but for me, what I appreciate and the types of buyers I want to work with
Yeah.
is somebody that's organized.
Right.
They have a buy box. They know what they're going after. They have specific experience or direct that translates into that business that they're looking to acquire,
Yeah.
and they have a team. So they
Yeah.
have a team. They have a lender. They have legal and CPA and accounting services at their disposal, and they're ready to go and
Yeah.
take control.
So why don't we talk about like the buyer strength financially relative to deal size and kept there. So like we'll see a lot of people where they're coming out of the arms, they might have a top MBA, but they've lived in a living city like in New York or Chicago, so they
Hmm.
haven't had a high rate of savings. And they might want to buy a $4 million business. And let's for discussion purposes or illustrative purposes, they have all of $250,000 of net worth and maybe 30,000 liquid, but they want to raise the rest from equity. How do you look at that of a person where you clearly have a sharp buyer and it's someone where, if they're buying a good business, presumably they're astute enough to manage it well, need that actual equity to bolster their personal financial statement? Is that an avatar that gets done with your bank and or how do you think about that?
Yeah, that's a great question. That's a fully loaded question. There's a lot of ways to break that down to. So I think what you're trying to get to is what kind of deals and buyers make sense to get to the finish line in today's time. A few things that we look at, that I look at it from my point of view is number one is cash flow, right? What is the business that this buyer's looking at? Measure as from a debt service coverage perspective. Do we have our minimum 1.25, 1.30 debt service year over
Yep.
year? What's the EBITDA cash flow leverage look like, right? Are we overextending the valuation of this business, leverage perspective of how much debt we're going to put on? And then now to your point with the actual individual, what kind of cash do they have, right?
Yeah.
Are they able to put 10% equity injection, or do they need to go out and raise capital or have able involved? That's going to be contributing some of those monies. And then also what we look at is what is their personal income like?
Mhm.
Does this experience, executive have a day job? Do they have a W-2?
Yeah.
So plan going forward, are they going to keep the W-2, or they're buying this business and this is their primary source of income for personal cost of living expenses?
A couple questions there. So funded debt to EBITDA, for people that aren't familiar, give a cap cursor high level on that just to explain broad brush strokes, more or less.
Yeah, like what are you paying for this business that you're buying? What is it worth essentially versus what kind of adjusted cash flow there is to support the amount of a loan you're looking at, right? So if it's a $5 million purchase, for example,
Yeah.
you're putting down 10%, we're financing, let's call it $4.5 million.
Mm.
And then what is the SDE for that? Is it 4 times? Is it 3 times?
Yeah.
But what does that valuation come out to? So over the last couple of years, I would say in small business lending in the SBA landscape, we're looking at about a 3 multiple,
Mm.
right? And
3 multiple of funded debt to EBITDA.
funded, that's correct. But as of late, and you know this, I mean, we've seen a lot more private equity come in, changes of valuations where the sellers think their business is worth more than what the
Right.
bank is willing to lend upon.
Yeah.
So we've seen that 3 multiple funded debt to EBITDA go up to times 4.5. All you're really doing at that point, in my opinion, is you're taking on a little bit more risk.
Mhm.
As a first-time buyer, you want to try to stay close as possible from a funded debt amount to that EBITDA multiple of 3.5.
And we're looking specifically just SBA financing, not also the seller note too, or is that including that funded debt to EBITDA?
Well, typically we're looking from the primary, which is going to be the bank
Mhm.
perspective. It's typically this, depending on how we structure those, they should be on some kind of standby, I would
Right.
say, right, for the first 2 years.
The keyword is should, right?
So looking at it from our debt perspective versus what this cash flow is coming in from this business, you never want to overpay for a business
Yeah.
and then be suffocated from day one when you get the keys to a business and worry about a seller note,
Yeah.
bank payments, and payroll.
Now, you brought up an interesting point a little bit earlier on, back when you were answering the question on talking about outside income, levers of those nature. And so, in the business buying space, you have everyone from someone paying $800 to rent in a Midwest city, maybe a 1-bedroom apartment, to someone that could have a $7,000 per month mortgage and, a big house, right?
Right.
How do those things impact the concept of global? And when you're a buyer looking at deals, modeling what you need to take as a salary, how are you as a bank ultimately going to look at that?
Yeah. That's a good question too. I would say first is what's the debt to income ratio look like on the sponsor side? Let's forget the business for a second because we look at both. We look at the business standalone and we also look at the guarantor. What does their debt to income ratios look like? Typically for us, we want to see about 50% debt to
Mhm.
income or lower. The lower, the better. So let's say you have a home mortgage, you have a home equity to your point, you have other obligations.
Yeah.
And for example, your annual debt payments are $50,000 a year.
Mm.
What we like to see is about $100,000 of actual annual income or better. So that way you can service your own personal cost of living expenses before we take a look at the business debt service coverage ratio and what kind of officer comp you can draw upon that. But now back to your second question on the business side, what we would do is first take a look at what's been happening historically. What's the cash flow? What's the officer comp that the seller's drawing? If it's anemic,
Yeah.
that could be an issue, especially if our buyer doesn't
Yeah.
have a W-2.
Right.
It all depends on kind of what that business is, what's the cash flow from that business, and either deficit on the personal side or the business side, because then we would have the distribution to
Right.
cover their personal cost of living expenses. So just the way I like to structure deals is if they're willing to guarantee the deal and they're comfortable with their husband or wife being
Buying
involved
the
in the
business.
business,
Yeah.
yeah, they can person guarantee as well, even if they don't have the ownership,
Right.
and we can count their W-2 income for outside wages.
Interesting. Super interesting. So talk about post-close liquidity. So back to let's just say hypothetically, north side of Chicago.
Hmm.
I want to go buy, and it's
Okay.
4 million SBA loan I'm looking for, bigger company. And you're looking at my personal financial statement, where I Zoom call or Teams. I believe Huntington is a prolific Teams user.
Hmm. Hmm.
How are you looking at what amount of cash do you want to see that I have left over in the bank after making my portion of the down payment? And then second part of that question is from a post-close liquidity standpoint, can we look at things and consider things that aren't necessarily cash in my personal financial statement, but maybe working capital in the balance sheet of the business, if there's a line of credit involved, and or if I have a home equity line of credit, does any of that get taken into consideration or just my personal cash liquidity?
Yes, yes, yes to all those items you mentioned. So first, we're going to take a look at personal financial statement, get a recent bank statement, see what kind of actual cash they possess. It could be in a checking account, saving account, investment account, non-retirement, cash value of life insurance. So
Mhm.
that's what we look at first. If there is no investors involved on the cap table, it's 10% equity injection. It could be a combination, maybe 5% from the buyer, 5% as a seller note on full standby for 10 years now. We can count that. And then after we get past that hurdle and the deal closed too,
Yeah.
at 90% financing, let's say, where the bank's bringing in 90% of then the buyer seller have the other 10%, we like to see close to about 10% post closing liquidity, which is the hot buzzword. And
Hmm.
the reason why is we want to make sure if things happen with the business, what things will happen and
Hmm.
changes will occur, you're prepared and you have reserves, you have emergency funds you can tap into besides for what the bank's going to give. So to your point, can we use a home equity line of credit that's got a zero balance, but a limit of 100, $200,000 on that transaction as liquidity,
Yeah.
possibly mitigant. Can we use the bank's permanent working capital, our revolving line of credit that we put in every deal at closing? Possibly. Um, do they have maybe some gift funds that they can use, family and friends, the equity injection, and not use all their cash?
Yeah.
That could account for sure. And then obviously whatever the seller has from a working capital perspective, if there's accounts receivable, if there's cash accounts that the buyer is going to inherit as
Hmm.
soon as they take over the business, all of that will limit that 10% requirement for post.
So for would you say, kind of generally speaking, Sarab, in broad brush strokes, the more post-close liquidity that you can point to just from cash, taxable stocks on the personal financial statement, the less in the weeds you have to go with pointing to those other things, and all else equal, the higher the odds should be of an approval.
100%. And, I can't remember who it was, but a previous predecessor, one of the credit told me something that stuck with me for a long time at a previous firm. And he said cash, a lot of diseases in
Mhm.
credit and underwriting. So if you have cash, you can get around some of the other concerns. Maybe it's lack of, maybe there's no collateral. That's why
Right.
we have the SBA for the guarantee to shortfall some of the collateral. Maybe it's personal, income, debt to income ratio is a little bit tighter. But if you have cash flow,
Mhm.
uh, I think there's a potential there.
One is there's kind of, especially with the new SBA guidelines, a fairway, if you will, that's narrowed a little bit. Where if you have too much cash, you're too rich, and then you don't meet the credit elsewhere guideline.
Yeah,
So
3 times
yeah,
liquidity perspective. But
yep,
honestly, I haven't really run across a lot of that.
yeah,
None of my really either because we talk on a regular basis because it's where that cash is. Is it in
right,
a trust? Is it a revocable trust?
mm,
Where are those funds parked? Who's the trustee? So there's ways where it might not have a direct impact on you being too.
yep, yeah, definitely rare. I mean, I had a guy that sent us a 9 personal financial statement. Not when we looked it together, but there are unicorns out there. They just typically aren't looking at SBA financing.
And we actually did have a deal you and I kind of looked at together where a lot of that money was in a trust. It wasn't the only trustee. There was other people involved making decisions for those trusts that
Right.
technically was not his money. And then also I think in that scenario, that gentleman also had an exit coming up. So there's gonna be a lot of
Mm,
proceeds coming down 6 months down the pike that he was counting today on the personal financial statement. That never happened yet.
Yeah, we get all the strong, interesting people typically at Pioneer. So another question for you. Let's talk business licensing. So just do a cannonball into the deep end here. So let's say I'm coming from Harvard, been one of these MBA programs, or maybe a corporate job at Amazon. I want to buy one of these HVACs, roofings, or whatnot. And based on the requirements for the state, there's someone in the business, an employee, or someone staying on that can be the qualifier of the license for the business. But perhaps the bank wants to see the qualifier being instead of actually being like, the person working the business. Is that something that you ever run into, or I've seen that ask
yeah.
come up from time to
Yeah,
time.
working on together now where the gentleman's buying a construction
Mhm.
in the West Coast in the San Diego market, and he's not a general contractor. You know, he's got his MBA, he's got a strategic background, but able to get around that specific scenario. That's a change of ownership, 100% business acquisition, because there's an employee there that's got a license. So he's kind of the master foreman, the main guy go to for the construction bidding process and
Mhm.
the license, and he's going to sign a 2-year employment agreement. So because of that, we're comfortable leaning into the deal.
Interesting, interesting. It definitely seems like something that's very bank. I've seen some where they've pushed for someone that is an equity holder. So basically, weaving in a general manager or someone as a minority equity holder so that you have that continuity of the licensing. So it seems like it varies a bit from one.
Yeah, I think we're flexible, but we
Yeah.
need to make sure we know who's going to be in control of the license. If we have nobody, that's a concern.
Yep.
And as you know, big difference between Georgia laws and California laws, where
Right.
the buyer could be the one that holds the license as soon as it passed the test
Yeah.
in 30 to 60 days versus maybe California, where it can take a year to two.
Yes. I mean, some of these states are kind of Wild West. Others are so regulated. I want to live there. It's
Absolutely.
crazy. What was I going to ask? Talk to me from a high level about when you're with my team at Pioneer from the lender side. What makes it easier for you relative to if someone's reaching out directly, kept on the margin, like the deliverable you get from us, not to give a sales pitch or
Yeah.
commercial here by means, but talk to me about like how that makes things go faster or moves things more efficiently.
Yeah, I mean, not to give you a shout out, but I truly do a great job. You guys handhold clients throughout the whole process. I mean, think about it. If you're a first time business buyer, there is so much to an SBA process. I mean, start to finish, it takes 60 days, 90 days, depending on buy side sales. I truly like about what you guys do is you have a full team dedicated to that buyer to make it a better customer experience because you walk them step by step of what it takes, what type of data room to set up, what kind of personal financials to get prepared and ready for,
Yeah.
besides for some of the due diligence and the cash flow on the historicals on the business that we're talking about. So I think it goes a long way because what folks don't see is that's an added service that,
Right.
especially if you have a day job and you're trying to figure out how to navigate the SBA process by a business and understand SDE, add backs, cash flow levers. That's a lot for most folks unless you truly have a strong finance background. So I think you guys, kudos to you guys. You built out a great team and a great partnership here. And you guys make it a little bit easier for the lender to just focus on the key things of, hey, do we have the financials? Do we have a full package? Can I quickly underwrite this thing and get a term sheet out?
And ultimately, we're getting paid by Huntington, not by the buyer. So if the deal doesn't close, there's effectively no risk.
Yeah, yeah. And again, I mean, we're in the people business. People say it's a truly a people business. And we have to understand that behind each deal, there's somebody's livelihood there on the buy side and the sell side, right?
Right.
And I think having good character, having a good moral compass, doing the right thing, integrity, trust, you guys do a great job and we try to reciprocate that. That's just the way I operate.
Yeah.
So I think that's important in this space too.
Would you say from a high level too, like, because I know back when I worked at the SBA banks, there's the workbook that where the lender sends to the analysts to put the credit memo together. I'm probably doing a bad job explaining it,
Hmm, hmm.
and there's nuance involved. Does having the workbook from us make your job faster, or is it kind of just doing the same thing?
Oh, absolutely, it is. But I mean, I trust you guys, but I still need to verify when I
Right.
do my summary and
Right.
narratives and so forth. But I think it helps save a lot of time if you guys have real data that's specific,
Yeah.
detailed, realistic. I can take a look at that, see year over year, 22, 23, 24, interims, TTMs, what's the trend, what's the financials look like. And it saves me a lot of time.
Super, super helpful and good to know. Talk to me about roll-ups. So that's one thing a lot of people want to do. Back to the discussion point around private equity and people that where that's commonplace, right? You get platform business,
Hmm.
and that's the initial one, right? And then you scale by doing add-on. Eventually,
Sure.
a lot of people get in this space. One of the things they want to do, they watch the podcast, they read my Twitter feed as well as others too. They want to do a roll up in industry. Generally, there's a geographic thesis around it. Stage track, maybe it's roofing, maybe it's plumbing, maybe it's landscaping. How do you, as a lender, Sarab, look at the spacing between acquisitions from the time someone buys the initial platform to their readiness to buy the next one,
Hmm.
and what you as a lender and/or the underwriter at your bank
Yeah.
ultimately wants to see to know the first deal is stabilized to the extent where they can buy the second one and not be moving too quickly?
Yeah, it's a great question. And we get that all the time where I think you have to be able to walk before you can run.
Mhm.
You can't do a marathon tomorrow morning unless,
Well, so not to that year. I did a half marathon for less than 3 weeks. I think it's person user dependent.
Yeah, yeah. Well, I mean, it took me about a year and a half to do half. Yeah, case by case, but you need to walk before you start running, and proof is in the pudding. If this is your first acquisition we've done in 2025, and it's been 3 months, and you're looking for a second acquisition, that's tough because we need to have a track record of
Mhm.
performance, right? It's great that you have a great business plan, you have a great thesis, but we need to see real data, real numbers. So I always say we want to see closer to about a year before we
Got it.
do a second one. That way we can understand how has the first one performed post closing. Have you hit your benchmarks? Are the projections kind of coming around together? Is
Yep.
it positive cash flow? And then if that is, and you check those boxes, I think we're ready for the second opportunity if that one makes sense, depending on, the business plan.
Interesting. Super helpful. Okay, so just to go a couple to talk about refinances. So maybe we'll start with SB to SB refinance. So let's just say a hypothetical. Someone bought a business a couple of years ago. Things have been going well. They're at a higher credit spread from their bank, prime 2.5 or prime 2.75,
Sure.
and things are going well financially. They like the 10-year amortization that comes with most, unless there's real estate when it's longer, and they want to start, creating cash flow savings. How do you look at those opportunities? So let's say watching this and they're in that position. What are things that you would want to see from a financial standpoint and or business plan standpoint to know that this would be something that you'd be able to get done?
Yeah, yeah. I mean, years ago, you couldn't really even do 70 to change over the years, and you can look at refinancing debt from. And we've done a few. I think it really needs to make sense with the story, what that business owner is trying to accomplish. What's important to them? Is it because they want to lower their payments? Is it for cash flow purposes? Is it because that SBA lender thought they wanted to be an SBA and now decided to bow out and get out of the SBA
That
space?
was that was what we had happen.
Yep,
Yep.
yep, yeah,
Yeah.
and I mean, you could talk scenario because you initially had business in Florida. I think it was a business, and that SBA lender.
So that one
Yeah.
we were actually not involved on acquisition financing.
Okay.
I talked to that guy and he linked up with that specific bank.
Got it. And I mean, you know more of the details.
Yeah.
It was a Midwest that SBA lending
It
in.
was actually Texas.
Texas. Okay.
Yeah.
It was in Texas. They decided to move out of the SBAs. So you have a client that's growing that needs access to more capital, and you have
Mhm.
a bank that's essentially handcuffed and deciding to, opt out of the SBA lending space. So that's
They
where I
were
came in.
actually trying to give credit, if I recall correctly. It was something to that degree.
Wow.
Like that they're
Yeah.
telling
Yeah.
him he couldn't use it. It's like that's not how it works,
Yeah,
right?
yeah. So as
Yeah.
soon as we got called, did our initial call right away, I knew an opportunity here there because that existing bank wasn't taking care of what the client needed. They
Right.
were saying essentially, "Hey, we can't help you." Where for us, we saw the projections, we saw the historical performance, and every year his business was just from a profitability, revenue perspective, net income,
Yeah.
it was going the right direction. And he just needed more capital, actually. He needed
Right.
to replace the existing line of credit that he had that was tapped out, take a larger line of credit and refinance his debt,
Yep.
put him at a better place to grow for the future. And that's the perfect.
Yeah.
And we got that done, provided him the additional fresh line of credit for short-term borrow, and then restructure his debt to save him on his monthly payments. And now he's able to take on more customers.
One of the interesting things, so pivoting, and thanks for covering all that, Sarab. So pivoting from refinances to lines of credit, is there bankers or lenders where it seems like the way they think about the line of credit is it's kind of there almost as what do they call those things the lifeguards throw
Buoys or the buoys?
the the life things, right?
Yeah.
Like it's there in case things aren't like going well. So some bankers I've talked to philosophically, they don't like doing that line of credit because they look at it as, if things are hitting the fan, the client's going to draw it all the way up. It'd be evergreen or fully maxed out. Whereas the way I look at it is, if you have a business like that one question, which is a landscape company, you're growing, you're going to have a working capital need where there's going to be expenses you're going to have to cover, people you have to pay to hire before you can start realizing this issue. Is that how you look at it, would you say, typically? Or
I would agree with you. And maybe some of the folks you've talked to, that sounds more like a conventional lender
well, some of
perspective.
these are SBA lenders, and like they'll do advising. And if you as a buyer care revolving working capital, they'd rather just do it as permanent working capital and skip the line of credit altogether.
Yeah. See, at Huntington, we don't operate that way. We want to make sure from day one we fund working capital, and pretty much every opportunity, every funding we do, we try to provide a working capital express line of credit as well, which is interest only, typically for 5 years.
Yeah.
And that creates more flexibility when you need to tap in, especially if you have senior business. Like,
Right.
how do you know you need the same working capital in June versus December?
And there's honestly really no reason not to get it because, I mean, it's just another set of paper that you have to sign, which just is. And then there's the packaging fee, which I think is like $2,500.
Well, the bigger thing is let small businesses fail,
Right.
lack of working capital.
Yeah.
We want to make sure we help these businesses progress and grow and eventually come from business to medium-sized businesses and then grow scale all the way up to middle market public companies in the future is kind of the way to do it.
And one of the problems too, I was actually I was getting gas this morning, and when I was at the gas, my former clients, Rishan, called looking to. I think you may have spoke with this guy. He is to refinance out of an SBA 7A loan with a different bank at a higher forever prime, and one of the driving reasons he needs a line of credit. And if you close an acquisition loan without the line of credit, the bank has a first lien on all of your business assets. So if you want to get a line of credit, if it's not from that bank, the other bank will be in second position, which for anyone watching this podcast basically means that bank gets nothing in a liquidation scenario.
Yeah.
And so if you close on the business, if you buy it and you skip the line of credit, it's a huge pain in the back to try to get it. It's almost impossible.
Yeah, to redo, unwind other liens, UCC positions to make sure we're in first versus the bank.
Yeah.
That's just a nightmare. That's just a nightmare. So what I suggest is from day one with a lender, with a
Yep.
bank, with the team that understands working capital, understands seasonality in the business,
Yeah.
and understands there's ebb and flows. This is a living, breathing business. And
Right.
things are going to go up, things are going to go down, but do it the right way from the beginning. Make sure your business plan, make sure the team knows what they want from the beginning, and then have the right lending, the right solution.
Yeah.
Makes it easier.
Talk to me from a high level on the underwriting process. You have LOIs signed, you're working with either a Pioneer Capital Advisory, hopefully zero, or you're going directly to Sarab or to a bank. What does that look like from a process standpoint? So there's, a bunch of forms, tax returns, personal financials, resume,
Yeah.
things like that. So all that's said to you, what's next? Like what happens next?
Yeah. Good question. And maybe I'm jumping around a little bit, but I think you all get to maybe the term sheet portion of that process. Like, what does that term sheet look like? I know for myself, and we've done a lot of business together, and we've looked at several deals together. Send out a term sheet once I've got the financial, the data room. That term sheet needs to have some weight on it, has to have some merit. There's got to be a lot of time and energy spent by the lender, by the BDO officer
Yeah.
looking at that deal. So when I send out a term sheet, I'm pretty confident that this deal is going to get done
Right.
based off that specific structure.
Where
So
some term sheets from some banks, I mean, you could literally pour propane on them and light them on fire, and
yeah,
there's
yeah. So I mean, and what I like to do is when I have a deal, if it's there's things maybe I don't understand about it, I pick up the phone. I call kind of the underwriter, the credit manager, say, "Hey, you have a few minutes? I have something. I just want to make sure I understand correctly,
mm,
especially if it's construction related or progress billing. There's WIP reports in there involved, understanding, revenue recognition timelines and so forth. So I like to get on the call, walk through that. And once I understand the business model, how do they get paid? What's their cash conversion cycle? Then I can go back to the client and to you all and say, okay,
yeah.
we're ready for a term sheet and to get this formally submitted to the underwriting team.
So opportunity goes into underwriting, then there's is a back and forth between you, underwriter, client, or like
Yeah.
tell us kind of how does the sausage get made?
Sure, sure. Thing is, at least for me, I dig deep, do a lot more due diligence on the front end, maybe
Mm,
versus some of the other BDOs out there. I want to make sure I understand the business, understand the customer, understand any concentration risks. And in my narrative, in my loan summary, is labeled in there with strengths, weaknesses, the mitigants of why this deal makes sense and why I support it, represent this borrower.
mhm,
So I would say, personally speaking, most of the information that the underwriter needs should be in that write up.
got it.
If it's not, we will go back to the client, to your point, the first week and just clarify certain things, seller notes, terms, payments, etc.,
Yeah.
and then get the conditional approval.
Now, within that package, specifically business plan, make the underwriting go faster the better the business plan is, or is that a variable that you guys at Huntington don't allocate too heavily to? So long as like resume is strong, personal financial statement strong, in the business debt service coverage is there.
Yeah, I mean, I think the business plan is important, but at the same time, crazy with a business plan and have a 10-page business plan. I think the key thing is understanding who the borrower is, what's their background, what's their transferable skills into the business that they're looking to acquire, why are they buying this business,
Yeah.
and what's the plan post closing of how they're going to operate successfully. If you can have the bullet points personally, one, two pager on the business and who you are, I think that's what the bank wants to see.
Got it. And the business plan, just to kind of double click there from your perspective, and this kind of what I've ascertained from prior ones and conversations with different bankers like yourself, is it should read more like a management plan than an investment pitch. Seen both types be sent to me, where some of them honestly sound like you're pitching for equity, and others are like, this is what the business is, this is how the sellers run the company, this is what I, as the buyer, plan to do, and it
Yeah.
like spells it out.
I would say simplify the heck out of it.
Yeah.
Make it simple so a fifth grader can understand who you are, what's
Right.
your business. Make it complicated as an investment thesis. Then you start thinking, is this an SBA opportunity or
Yeah.
is this an investment play? Is this active involvement here coming in from the buyer team? So I would say less is more. Just be detailed, succinct with bullet points.
Right.
Doesn't have to be 10 pages.
And what I typically tell some clients who, especially when they're preparing for underwriting, is like, not to throw shade and talk down or whatnot of SBA lenders. I myself came from that space as ever a lender, as a closer. Is a lot of these people, it's like, they went to Big Ten schools, state schools. Like, these are not, you need to keep things basic,
Yes,
typically.
yeah. It's business lending, small to medium sized business lending. This isn't private equity, the wild wild west. You know, at the end of the day, we just want to make sure we understand the guarantor profile, the sponsor, right? Since they personally guarantee the deal, and then the business itself. As long as you can explain that, you do not need to go into, strategic initiatives, operational excellence to a degree. Uh, I would just say a couple of 2 pages, 3 pages is enough.
Got it. Got it. Talks about right now, as of the time of this video, we're in a government shutdown. So we're October 8th, 2025. Talk to me about let's say that I want to buy a business end of the year and time is of the essence. And I'm trying to figure out, what does the actual shutdown have as a bearing on me going through this process? Can I get started in the underwriting? Can I get a term sheet from a Huntington bank or similar? Or are we on full pause based on the fact the government shut down? Explain that at a high level.
Two parts. There is a government shutdown, so there's a small material impact depending on where you are in the process. But also, there is no impact. If you're talking to me today and you want to buy a business and you want to close before the end of the year,
Yeah.
we have a lot of work to do, and we should have been working on yesterday, right? So
Yep.
time is of the essence. Um, we are still underwriting deals. We're still analyzing deals. We're still putting together term sheets, approving deals. The only thing is when it comes to funding and getting that SBA number through the E-Tran SBA portal system is a delay right now, for
Right.
sure. But
Right.
that does not stop you from your business plan, from your projections, from your data room, from your financial statements, going under LOI.
Yeah, and if you look at, I mean, obviously not to get too speculative here, it's gonna, there's unknown unknowns, as Donald Rumsfeld once said. One, basically, people right now are betting the shutdown is gonna take like 3 weeks, give or take. That's what Vegas odds currently say. So if you go right now to the fact that we're 8 days into the shutdown, give or take, in another 2 weeks we could be back open. And so if you're kicking off the process now, by the time you get approved, knock on wood, best case scenario, we're back open for business.
Yep.
At that point, you can go through the closing process with the bank, and the closer at the bank can pull the loan approval number, and you're off to the races as a new minted SMB owner.
Yeah, and I mean, you still have to do business valuation. If it's a business opportunity, business valuation, you got a lot of,
Yeah.
UCC lien searches. You got some background stuff you're doing on the borrower, and then you still have to get the big ticket item. Is there a lease agreement that needs to be executed and put together?
Yep.
Is there a draft purchase agreement that both sides are finally at a place where they're comfortable after 5 versions of redlining, right? So there's still a lot of work that needs to be done. So
Yeah.
what I tell borrowers right now in today's time, as of today, is control the
Right.
what can you do today to move the needle, and let's put the SBA, the government shutdown piece, on pause for now.
Right.
Let's control what we can do.
Yeah, I mean the longest shutdown I think was 35 days. So obviously it doesn't go that long, but using that as a really November worst case scenario.
Yeah, yeah. But at the end of the day, you still need to get all the due diligence
Right.
done, right? You
Right.
got to make legal, accounting, etc. If it's
Yeah.
QV, get all that.
Right. No, definitely control your controllables. So one trend that I've seen recently, Sarab, at least here in prior years too, but more recently this year, is some of these banks either that got into the SBA space during the COVID pandemic, pulling out, like the one that we just kind of discussed and mentioned, and or banks being acquired by banks like Huntington,
Mhm.
for example. And so, question is basically, if your business and you're like a banks with, what are the implications of that for you, and how should you be thinking about what banks you should be talking to based on which ones might not exist any longer now?
Yeah. This is a tough one. I always tell buyers, prospects, pick up, shop around, talk to other folks, see who you feel comfortable with. What's a good relationship look like for you between lender and borrower? But at the end of the day, it really comes down to the strength of the bank, right? So Huntington Bank, I mean,
Right.
over the last 70 years in a row, number one SBA lender country in terms of units. Not sure where we land this year.
Mm.
Generally speaking, top 3 in the nation. So we've done this before.
Yeah.
It's not first rodeo, right? So that gives you confidence. And we have it's streamlined. We have a team dedicated just to SBA. This is what we do.
Right.
This is our bread and butter. I mean, we've been doing this for, decades. This isn't something just after COVID pandemic. We're like, the great place to be in. Let's go and push the S. So
Yeah.
this is who we are. This is what we do. This is what we do well. And quite frankly, that's why here is because they already had a process in place and they had consistent, predictable, repeatable results year over year. So
Right.
I would say it's important to vet the lender, vet the bank, but just make sure you're somewhere that's not a fly by night type institution.
Yeah. So like look at the scoreboard, but also talk to the banks to feel
For
them
sure.
out.
For
Yeah.
sure.
Yeah, that is kind of interesting because being in the position that I'm is, we have an aperture, Kevin, the broader market with different banks, what they want to finance, how their credit policies are. I'll have lenders that are switching banks, switching banks, some of which are former coworkers, others that are, and I'll get asked, should I go here versus there? And I was having a conversation with someone recently. I know, think about like if we went into a recession, even though we hope that's not going to, or if got bombed by Iran, which of these banks are going to be there tomorrow?
Yeah, yeah.
Right. And like Huntington is probably one of the ones I'd bet on.
Yeah, yeah. I mean, around 150 years as an institution, and assets. So, they're a pretty stable regional bank all the way from Ohio to Colorado states. And then obviously banks being acquired, Veritex Bank. Obviously, that's the other one, the news out of Texas.
Yep.
So yeah, we're not going anywhere. This is what we do. This is home processing.
Speaking about that, which kind of borders like it on the financial due diligence topic, if you will, how do you as a banker, or like how does your underwriting committee look at deals that work based off Q of E, based off of accrual versus cash basis? So as you know, you're aware lots of these sellers want to do cash based taxes because it makes the taxable income less, but then when they're being sold or getting prepared to be sold by the sell side broker, they're showing accrual P&Ls because it makes the earnings look higher. Like, how is there value in getting the QV from a standpoint of getting a deal through Huntington's underwriting committee, or is the QV just being done just to kind of give the buyer peace of mind? How do you think about that?
Yeah, this keeps me up at night, and we do this all the time, cash versus accrual on some of
Mm-hmm.
these deals that we're looking at and some of these acquisitions. The QV is great, first of all, right? I mean, there's no question about it. I mean, it's great to be able to normalize cash flows and understand seasonality, working capital pegs, and all that good stuff. But I like the fact that it's an independent third party, so it's not the bank,
Mm-hmm.
it's not the buyer, it's an independent third party that brings some value, which is worth the price because we'll take a look at that. I'll take a look at that.
Yeah.
Am I going to dig deep into the entire QV? Of course not. But I'm going to take a look at what's consistent from an adjusted EBITDA perspective. What makes sense year over year when you normalize some of these seller expenses? So I would say, yeah, we do put weight on QV, and then also cash to accrual reconciliation statements.
Yep.
Those are pretty important. When the numbers don't match, buyer doesn't have an idea of exactly why they don't match. I would hope the seller does, or the seller CPA, and they can reconcile those. And then the QOV is part of that due diligence too, so which is super helpful too. It helps me do my job too.
From a standpoint of getting the working capital peg right? So like in the LOI, generally it'll say buyer and seller agreed to such and such purchase price. Working capital peg will be determined financial due diligence. And then like they'll give whatever that is. I'm probably doing a shitty job at it because I'm not a QV guy or a lawyer.
Same.
But basically, do you see value in having the QV to validate what that number is so that, God forbid in the SBA loan, which is a type of loan for anyone not familiar, funding these acquisitions, that you don't have enough working capital coming from there, you're getting the appropriate amount from the seller. Would you say that that's a place of value for these QVs?
100%. I mean, you want to have enough capital. And like we talked earlier, lack of capital brings down a lot of businesses. So from day one, the analogy, you buy a car off parking lot, you want to have gas, and that's working capital.
Yeah.
So you want to make sure you have sufficient gas or working capital amount to run the business, operate the business, because to happen next week after you close.
Yeah.
And what locks don't talk about is the risk after you close with attrition, clients maybe not sticking around and being as sticky as you initially thought. So if you have that working capital peg, besides for maybe the bank providing working capital and so forth, but you get some of that from the seller, and you in the ninth inning before the day of closing or the week of closing, it level sets the expectation of what's expected from both parties, buyer and seller. I think that's pretty important.
How do you look at, so on the topic of working capital, so we briefly talked financial due diligence, QV benefits. Let's pause on working capital. Do you look at, so working capital true-ups, are those permissible typically with Huntington, or how do you look at that?
Yeah, as long as we understand how they're getting the number, what's the formula behind the true up? Are we just, or is there a reason based off of 90-day average, 30-day average, based off their cost of goods sold and their optional expenses? This is kind of we look at true ups. We just need to understand what is that true up for,
Got it. Let's talk about for industries that you're seeing that are pretty popular that people are acquiring in recently. What are some of what are areas of some recently closed deals that you've worked on?
Oof. Oh man, we've done from SaaS.
It's I guess a lot, sir, but like what are people buying?
Well, it depends on who you are. What's your buy box, right? I mean, every person's different. If you have somebody that's got an engineer background, is buying engineering services business, completely different than a restaurant, retail, franchise, food chain. So it's case to case. And again, from perspective, we're industry agnostic. It's about anything that makes sense on paper and is a good deal. But you have is obviously those are and the blue collar jobs, the HVAC, plumbing, electrical. In my opinion, I like more of the residential catering versus commercial in that because of the cash conversion cycle is much quicker.
Interesting.
So I
Less accounts receivable,
correct.
more cash
Correct,
based.
correct. So you know exactly kind of what your budget is, how much money you need allocated. You're
Yeah.
not waiting 30, 60, 90 days to collect on your receivables.
Right.
It's usually homeowners like you and I that don't know how to fix a broken pipe or
like painting the room. Right?
or painting, painting or whatever, you need to do some kind of air conditioning in the house, that kind of thing. So
Yeah.
I think there's a big demand for that. So I like that side. But again, I mean, we just recently closed in Michigan. It was a trash junk removal franchise business where all they were doing was dropping the actual dumpsters. So the business doesn't do anything except for drop the dumpster, pick it back up a week later, and it's automatic payments. It's charged on credit cards as soon as you drop the dumpster off. So, it just depends on kind of your background. What is it that you're passionate about?
Yeah, and that deal, if I recall correctly, I think your good friends over at Color Capital were involved.
I think so.
So
I think so. Yeah, that makes sense. I mean, it's all comes down to your team. I mean, the vendors, the third parties, you would hope they're professional and they're transparent and they do a good job for the client.
Yeah, Sarab, definitely appreciate you joining the podcast. Good to have you on here.
Yeah, thank you. I appreciate it as well.
Should definitely do it again.
Yeah, in person because we're so tied up to the screens and being on the mod me here.
Yeah, of course. Appreciate you joining.